Gentlemen, question for you. If AI can write code, draft emails, generate designs, and automate workflows, then what's the point of buying software stocks? Because the market is currently trading software like AI is going to replace it, when in reality, AI is being absorbed into software, and the companies that already own the workflows are the ones most likely to monetize it. That's why software stocks have been getting dumped. Investors are scared that AI will destroy moat, destroy pricing power, and destroy market share. In early 2026, the software ETF IGV was down about 15% year to date by February, and some big names have been crushed even after solid earnings. This is the classic narrative sell-off. But here's the contradiction. Many of these companies are printing cash. They're profitable. They have sticky customers. And they're not standing still. They're embedding AI into their products and charging for it. So my view is simple. Software may not have bottomed yet, and I'm not calling an exact low, but I think this is the time to start loading up some specific software stocks, and I will be giving them to you in this video. I also want to say this, we've actually seen this movie before. A clean example is Google. The market spent a long stretch fearing AI would destroy search, and then as the company integrated AI and they give us Gemini, the cash machine proved to the market that it kept running, and investors re-rated it back as a winner. I think software is setting up for the same kind of fear first, proof later cycle. Alrighty, so the very first stock I want to talk about here today is SoFi. SoFi is not traditional enterprise software, but it is absolutely a software platform business. It's a fintech platform with a bank charter, and it monetizes a multi-product ecosystem through software distribution, lending, financial services, investing, and a technology platform behind the scenes. The reason SoFi is on this list is the profitability inflection. In its most recent quarter, SoFi reported adjusted net revenue of about $1.01 billion, up 37% year over year, and it posted GAAP net income of about $173.5 million. Adjusted EBITDA was about $317.6 million. That's not almost profitable. That is very profitable. So why is this a software AI story? Because the more products you can sell inside one app, the more you can improve unit economics without raising acquisition cost. AI helps that flywheel by improving underwriting, fraud detection, personalization, and customer support efficiency. You don't need AI to replace humans completely. You just need it to lower cost per customer and increase cross-sell. SoFi also guided 2026 adjusted net revenue around $4.66 billion and adjusted EPS around 0.60, which is the type of forward signal that can force a re-rating if execution holds. Now, why is it undervalued? Because growth names still get punished when investors are nervous about rates and narratives. SoFi has been extremely volatile, and this might not be the bottom, but eventually the market will realize that AI is actually boosting SoFi's ability to earn, and this is about the time to get in. Next one up we have is Adobe. Adobe is the poster child for the AI will replace us fear trade. People look at generative image tools and say, why pay for creative software? But professionals don't pay Adobe for a single image. They pay for the workflow, control, collaboration, brand consistency, rights, reliability, and enterprise integration. Adobe owns the professional pipeline, and the numbers confirm it. In Adobe's most recent quarter, it posted record revenue of about $6.19 billion, up 10% year over year. Full year revenue was about $23.77 billion, up 11%. It generated GAAP operating income of about $8.71 billion for the year and operating cash flow of about $10.03 billion. That is a monster cash machine. Now connect that to the stock. Adobe has been crushed. Based on recent 52-week data, it's been trading roughly in the mid-200s to mid-400s range, meaning it's down roughly a third or more from its 52-week high. That is exactly the kind of drawdown that creates opportunity if the fundamentals don't break. And on AI integration, Adobe is not asleep. Firefly is being integrated across Creative Cloud and the workflow stack. The monetization path is not AI is cool. It's AI saves time, and time savings is what enterprises pay for. The market is waiting for an obvious proof moment that AI helps revenue and retention rather than hurting it. I think that moment is coming. Now let's talk about Salesforce, ticker CRM. The fear narrative says AI agents will replace Salesforce platforms. But in real enterprises, AI agents need data permissions, audit trails, governance, and clean integration into sales, support, and billing workflows. That means the system of record doesn't disappear. Instead, it becomes the operating layer for automation, and Salesforce is still performing financially. In its most recent reported quarter, Salesforce delivered revenue of about $10.3 billion, up 9% year over year. Subscription and support revenue was about $9.7 billion, up 10%, and the most important enterprise metric, current remaining performance obligations, was about $29.4 billion, up 11% year over year. That's contracted future revenue. Salesforce is also showing that AI is becoming a product line, not a threat. Management highlighted nearly $1.4 billion in ARR tied to its AI and data momentum drivers, up 114% year over year. That is the proof pattern you want. Not we announced AI, but AI is becoming recurring revenue. Now look at the stock. Salesforce has been punished. Its 52-week high is around 348, and it's recently been trading around the low 200s, meaning it's down roughly 35% to 40% from the high. That's what undervaluation looks like when the narrative is ugly, but the business is still selling future revenue. So I'm accumulating CRM with a long time frame. This is not a next week trade. Rather, it's a next year re-rating story as the market sees AI increases platform value instead of destroying it. Now, Microsoft. Microsoft is the anchor in this whole software AI conversation because it owns both the distribution and the infrastructure. It sells software to basically every enterprise on Earth, and it also sells cloud capacity through Azure. AI doesn't remove Microsoft. AI increases demand for Microsoft's stack. The latest quarter makes that clear. Microsoft reported revenue of about $81.3 billion, up 17% year over year, and operating income of about $38.3 billion, up 21%. Microsoft Cloud revenue was about $51.5 billion, up 26%, and Azure and other cloud services grew about 39% year over year. That is not AI eating software. That is AI pulling through cloud, productivity, and enterprise workflows. Copilot gets monetized inside existing bundles. Azure gets monetized as compute demand grows. And Microsoft has the distribution to push AI across Office, Windows, Teams, GitHub, and enterprise security. Now, why is Microsoft on a buy the dip list if it's so strong? Because even Microsoft can get repriced when markets worry about CapEx and AI spending. The stock has pulled back from its 52-week highs. Its 52-week high is around 555, and it's been trading closer to the low 400s, so it's down roughly 20% plus from the high. That's a rare kind of pullback for a company this central. And for Microsoft, at the end of the day, it doesn't really matter too much. This company is just too strong, and it's being punished not for a legitimate reason, so this will be a good investment no matter what. The final stock I want to talk about is the perfect example of the market being scared of the wrong thing, and I'm going to load this one up heavily. That is ServiceNow. ServiceNow is not nice-to-have software. It's operational infrastructure inside enterprises, IT workflows, employee workflows, approvals, ticketing, automation, and now AI-assisted operations. If enterprises deploy AI agents, those agents still need to live inside governed workflows. That's exactly what ServiceNow sells. And the numbers are extremely strong. In its Q4 2025 results, ServiceNow reported subscription revenues of about $3.466 billion, up 21% year over year, and total revenue of about $3.568 billion, up 20.5%. Current remaining performance obligations were about $12.85 billion, up 25% year over year. That is future revenue already sold. Current remaining performance obligations were about $12.85 billion, up 25% year over year. That is future revenue already sold. They also guided 2026 subscription revenue to about $15.53 to $15.57 billion, which implies roughly 20% growth on a constant currency basis. and they are profitable at scale, with management highlighting operating margin around 31% and guiding to around 32% operating margin and around 36% free cash flow margin. So why is the stock down so much? Because software multiples are compressing on AI fear, and because guidance is being held to an insane standard. ServiceNow's 52-week high is around 211, and the stock has been trading around the low 100s, meaning it's down roughly 40% to 45% from the high. That is a huge re-rating. This is why I'm buying. Not because it can't go lower, it can, but because the business is still growing around 20%, still generating strong cash flow, and AI is being integrated into the platform in a way that increases value to the customer. The market is waiting for the moment when AI doesn't just exist in the product, but shows up clearly in expansion, retention, and monetized demand. I think that moment will arrive, but it may take time. So, is it time to buy software stocks? My answer is yes, with the right mindset. Not all in today. Not call the bottom. It's time to start accumulating the profitable workflow owners while the market is scared. The key is that these companies are not vaporware. They make money, they generate cash. And remember, AI is not replacing them. AI is being embedded into them. Thank you for watching. Drop a like and subscribe if you like the content, and tell me what you want me to talk about next in the comment section below.